You've heard it a million times, right? Buy the dip. It's the go-to mantra for a whole generation of investors. When prices fall, you jump in and buy more. Sounds simple enough, but is this actually a smart path to getting rich? Or is it a really seductive trap that just leads to financial ruin? So, which is it? That's what we're going to figure out.
And let's just kick things off with a number that should really make you sit up and pay attention: 40%. Look, the data shows that 4 out of every 10 stocks that take a major hit, we're talking a 70% drop or more, will never, ever recover. Not in a year, not in a decade, never. And that's not just some weird stat about penny stocks, that's across the whole market.
So you've got this huge contradiction, right? On one hand, you have the cold, hard math that says a lot of these stocks are toast. But on the other hand, you have investors shoveling billions of dollars into these falling names, absolutely convinced they've stumbled upon the bargain of a lifetime. What is going on here? Let's dig in.
See, this isn't just a strategy anymore. It's become a habit, a reflex. And we're not talking small potatoes here. The sheer scale of this habit is, well, it's just mind-boggling.
Get this. On one single chaotic day when the market was tanking, retail investors, that's folks like you and me, poured a record-smashing $5.1 billion into U.S. stocks. That is the biggest one-day inflow ever. It tells you everything you need to know. When the market panics, the modern investor doesn't head for the hills, they go shopping.
So why all the confidence? Well, as strategist Steve Sosnick points out, it's pretty simple. For a long time, it's been a money-making machine. For the last decade or so, every time the market stumbled, it came roaring back. That experience has literally trained an entire generation of investors to believe that every single downturn is just a temporary discount. And that kind of conditioning is powerful, and, as we're about to see, potentially really, really dangerous.
And this right here, this is the absolute heart of the problem. To win this game, you have to know the difference between a simple dip and something way, way worse. Because trust me, not all price drops are created equal.
So on one side, you have your classic dip. It's a temporary speed bump for a great company. It's an opportunity. That's what we're all hunting for. But on the other side, you've got what they call a falling knife. This is a stock in a death spiral, and nobody knows where the bottom is. It's a trap. And here's the kicker. The difference between that golden opportunity and the trap, you almost never know which one you're holding until it's way too late.
So what are the real odds of you being a hero here? Well, one massive 20-year study looked at stocks after a big drop and found that only 28% actually recovered and went on to beat the market. That means nearly 3/4 of the time, 72%, pouncing on that bargain was a losing move. You're basically betting against the house, and the house has a 72% edge. Yikes.
Okay, so if the math is so clearly stacked against you, why are so many people still playing this game with such confidence? Well, the answer isn't really in the spreadsheets. It's about what's going on inside our own heads.
You've got 3 huge forces pushing us to do this. First, there's recency bias. We all remember the COVID crash in 2020, right? And how incredibly fast it bounced back? That V-shaped recovery is burned into our brains. Second, you have frictionless trading. It's just too darn easy to open an app on your phone and hit buy with 0 fees. Impulse can take over. And third, there's this idea of the Fed put, this deep down belief that the central bank will always step in and rescue the market if things get too ugly.
And the thing is, this behavior now has a huge impact on the market itself. Retail investors now own 38% of the entire U.S. stock market. This isn't some tiny group anymore. Their collective buying can actually prop up falling prices, turning buy the dip into a self-fulfilling prophecy, right up until the moment it isn't.
Okay, so if blindly buying every stock that drops is a losing game, how in the world do you actually make this work? Well, the answer has almost nothing to do with perfectly timing the bottom and everything to do with what you are buying. It all comes down to one single word: quality.
And this is where things get really interesting. Remember that scary 28% recovery rate for the average stock? Well, look what happens when you only look at high-quality companies. The success rate jumps all the way to 39%. Now, that 11-point difference might not sound like a lot, but in investing, it's everything. It's the gap between a strategy that usually fails and one that gives you a fighting chance. Let's look at a real-world example. Think back to late 2018. Apple stock was getting hammered because everyone was freaking out about iPhone sales slowing down. That was a classic dip. And the investors who bought then were handsomely rewarded. Why? Because the problem was temporary, but the company's fundamentals, its insane cash flow, its brand, its profitability were rock solid. It was a quality company with a short-term headache.
Now let's flip the coin. Contrast that with General Electric just a year earlier. The stock was in free fall, and tons of people jumped in, thinking, wow, an iconic American company's on sale. But this wasn't a dip. This was a falling knife. The stock price was dropping because the entire business was broken and drowning in debt. Buying that dip was an absolute catastrophe.
So, when we say quality, what are we actually talking about? It's not just a gut feeling, it's a list of things you can actually measure. We're talking about companies with consistently high profits, strong and steady sales growth, and a clean balance sheet that isn't loaded down with debt. Those are the traits that give a company the strength to get back up after being knocked down.
All right, let's pull all this together and land the plane. How do you separate a smart, calculated risk from just a stupid gamble? It really all comes down to following a few simple but non-negotiable rules.
Think of these as your survival rules. First, position sizing. Never ever let one of these bets grow to more than 5% of your entire portfolio. Second, have a stop loss. Before you even click buy, you need to know exactly at what price you'll admit you are wrong and sell. Third, know your time horizon. And fourth, diversify your dips. Don't bet the farm on one single turnaround story. Let's just lay it all out, side by side. The difference is night and day. The stupid way is following hype on social media, throwing more and more money at a losing bet and just kind of hoping for a bounce. The smart way is doing the actual research, managing your bet size, having a clear reason why the company will recover, and always protecting yourself if you're wrong.
So here's the bottom line. Buy the dip isn't an inherently smart or stupid strategy. It just is. The thing that determines whether it's smart or stupid is your process. Are you gambling based on hope, or are you investing based on a disciplined, well-researched plan? That is the only question that matters.
And that leaves us with one final thought to chew on. Success with this stuff isn't about being a genius who can predict the future. It's about having discipline, a solid process, and managing your risk. Because at the end of the day, the real question isn't whether you're smart enough to buy the dip. It's whether you're disciplined enough to do it the right way when everyone else is panicking.